Hello and welcome back to our channel, where we bring you interesting and informative videos on a wide range of topics. In today's video, we will be discussing the world's most expensive currency. Currency is a medium of exchange that is widely accepted in a particular country. Every country has its own currency, and the exchange rate between currencies is determined by several factors, including supply and demand, interest rates, inflation, and political stability. In today's global economy, exchange rates fluctuate constantly. Therefore, the value of a currency can change rapidly. Some currencies are worth more than others, and some are more valuable than others. Here are the top 5 most expensive currencies in the world. KWD, the Kuwaiti dinar, is the highest valued currency in the world. 1 Kuwaiti dinar is equal to $3.29. BHD, the Bahraini dinar, is the second most valuable currency in the world. 1 Bahraini dinar is equal to $2.65. OMR, the Omani rial, is the third most valuable currency in the world. 1 Omani rial is equal to $2.60. The Jordanian dinar is the fourth most valuable currency in the world. 1 Jordanian dinar is equal to $1.41. GBP, the British pound sterling, is the fifth most valuable currency in the world. 1 British pound sterling is equal to $1.39. Reasons for the high value of these currencies. Now, let's explore why these currencies are so valuable. The Kuwaiti dinar's value is mainly due to its country's rich oil reserves. The country's economy is heavily reliant on oil exports, making it one of the wealthiest nations in the world. The Bahraini dinar's value is also due to its country's oil reserves. Bahrain is an oil-rich nation, and its economy is heavily dependent on oil exports. The Omani rial's value is also linked to oil reserves. Oman is an oil-producing nation, and its economy is heavily dependent on oil exports. The Jordanian dinar's value is due to the country's stable political climate and strong economic policies. The British pound sterling's value is due to the UK's strong economy, political stability, and global influence. Besides the factors mentioned earlier, there are other factors that can affect a currency's value, including a high inflation rate can decrease the value of a currency as it reduces the purchasing power of that currency. Higher interest rates can attract foreign investors, which can increase the demand for a currency and therefore increase its value. A country with a trade surplus, exporting more than importing, can increase demand for its currency, while a country with a trade deficit, importing more than exporting, can decrease demand for its currency. Political instability, conflicts, or changes in government can decrease the value of a currency as it reduces investor confidence. The monetary policies of a central bank can influence the value of a currency, such as adjusting interest rates, buying or selling currency in the foreign exchange market, or controlling the money supply. While the top 5 most expensive currencies listed above are the highest valued in terms of exchange rates, there are other valuable currencies as well, including the Swiss franc is known for its stability and neutrality. It is widely accepted as a safe haven currency, and its value is often used as a benchmark for other currencies. The euro is the second most traded currency in the world and is the official currency of 19 countries in the European Union. The US dollar is the world's most traded currency and is widely accepted as the global reserve currency. It is often used as a benchmark for other currencies. The Japanese yen is known for its stability and low inflation rate. It is often used as a safe haven currency, especially during times of economic uncertainty. Currency trading, also known as forex trading, is the buying and selling of currencies with the aim of making a profit from the exchange rate fluctuations. It is one of the largest financial markets globally, with an average daily trading volume of over $5 trillion. Currency traders often use leverage to increase their potential profits, which is borrowing money to trade with a larger position than the initial investment. However, leverage also increases the risk of losses, and traders should be aware of the potential risks involved. Exchange rates are the prices at which one currency can be exchanged for another. They are determined by the supply and demand for currencies in the foreign exchange market. The exchange rate of a currency can have a significant impact on the economy of a country as it affects international trade, tourism, and foreign investments. Exchange rates can be quoted in two ways, direct or indirect. In a direct quote, the domestic currency is the base currency, and the foreign currency is the quote currency. In an indirect quote, the domestic currency is the quote currency, and the foreign currency is the base currency. Currency appreciation refers to an increase in the value of a currency in relation to other currencies. It can occur due to various factors, such as an increase in demand for the currency, higher interest rates, a positive trade balance, or political stability. Appreciation can benefit a country by making imports cheaper and increasing the purchasing power of its citizens. On the other hand, currency depreciation refers to a decrease in the value of a currency in relation to other currencies. It can occur due to factors such as a decrease in demand for the currency, lower interest rates, a negative trade balance, or political instability. Depreciation can make imports more expensive and decrease the purchasing power of a country's citizens. Currency manipulation refers to the deliberate actions taken by a country's government or central bank to influence the value of their currency in the foreign exchange market. These actions can include buying or selling currency in large quantities, imposing capital controls, or manipulating interest rates. The goal of currency manipulation is often to boost a country's exports and make them more competitive in the global market. However, it can also create trade imbalances and spark currency wars. Currency pegging is a monetary policy where a country's currency is fixed to another currency, usually the US dollar or the euro. The exchange rate is maintained within a specific range by buying or selling foreign currencies in the foreign exchange market. Currency pegging can provide stability and predictability for businesses and investors, but it can also limit a country's ability to respond to changes in the global economy. Bitcoin is a digital currency that operates independently of a central bank. It is decentralized and operates on a peer-to-peer network, allowing for secure and anonymous transactions. The value of Bitcoin is determined by supply and demand in the market and can be highly volatile. While it is not a traditional currency, it has gained popularity as a speculative investment and a means of payment in some countries. Cryptocurrencies are digital currencies that use cryptography for security and operate independently of a central authority. They can be used to buy goods and services, and their value is determined by supply and demand in the market. Cryptocurrencies have gained popularity as a means of payment and a speculative investment, but their value can be highly volatile due to their decentralized nature. In conclusion, the value of a currency depends on several factors, including political stability, economic policies, natural resources, and global influence. The top 5 most expensive currencies in the world are the Kuwaiti dinar, Bahraini dinar, Omani rial, Jordanian dinar, and the British pound sterling. These currencies are valuable due to their country's oil reserves, stable political climate, strong economic policies, and global influence. We hope you found this video informative and interesting. Thank you for watching.